Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we unpack deferred revenue, also called contract liabilities under IFRS. You will learn what it is, when to record it, how it unwinds into revenue, clean journal entries, common examples like subscriptions and gift cards, plus mistakes and simple controls. But first, a quick refresher. What is deferred revenue and why does it exist? Deferred revenue is cash collected before you have earned it. The customer paid, but you still owe a product or a service. Until you deliver, it is a liability on the balance sheet. Accounting recognizes revenue when controlled transfers or service is provided, not when cash arrives. We have already briefly discussed deferred revenue as part of Unearned revenue lesson. You can take a look at video number 9, don't count it yet. On the balance sheet, deferred revenue usually appears in current liabilities for amounts you expect to earn within 12 months. And in non-current liabilities for the rest. In IFRS, it is often called contract liabilities. For classical deferred revenue, here are the most common cases. Subscriptions and SaaS, when a customer prepays for access over time, for example 12 months. Gift cards and vouchers, which means cash received now and the right to redeem later. Loyalty points, a portion of the sales price is deferred to cover future rewards. Sometimes you will see prepayments received also called deferred revenue, and they indeed are part of contract liabilities under IFRS. And effectively, deferred revenue is a prepayment received. But often, from a commercial standpoint, deferred revenue is perceived somewhat differently to classical prepayments. In practice, when talking about deferred revenue, one would normally mean something of a recurring nature, when you collect cash in advance on a regular basis and commit to provide an ongoing service or deliver goods on a recurring basis, daily, weekly, monthly, and so on, a non-stop and recurring progress until you fulfill your obligations. At the same time, prepayments are mainly focused on the fact of an advance receipt of cash for something, also as a source of pre-financing or security. Let's say we normally sell apples with credit period granted to our customers. And normally, we expect the customers to pay us in 30 days after the delivery of apples. Suddenly, we decide we could improve our liquidity position and ask a few customers to make a prepayment for apples. Or we have a new customer whom we don't trust yet. They pay us in advance and we deliver later. After the receipt of cash in advance, we reflect the obligation on the balance sheet, prepayments received as a liability. Similar situation, we are selling some equipment and ask our customer to make a 30% prepayment. Or for example, we book a holiday where the tour operator asks us for a partial down payment. They would record it as a prepayment received. Another situation, you know your customers love your apples and constantly buy them, so you offer them the following. They prepay for a few months or a year and then you supply them a few kilograms of apples every week. Their benefit? They get fresh apples recurrently over a period of time. And don't bother of placing orders every single time. You might have heard of some companies who deliver pre-cooked meals or ingredients to cook on a subscription basis. In those cases, it would make more sense to call it deferred revenue, to reflect the recurrent situation for your revenue model. Deferred revenue became very common on the balance sheet with the rise of the mobile contracts, software maintenance and subscription contracts, SaaS or similar. Before we move on, if you find our lessons useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. And thank you for being with the channel, this is very important for me. Now let's get back to our Apple shop. Our Apple shop takes a $600 prepayment today for apples to be delivered over the next quarter, 1/3 each month. Cash is in now, but no delivery and no sale yet. At prepayment, we record the following journal entry. Debit cash $600, credit deferred revenue $600 to acknowledge the commitment to deliver. On the delivery next month, we have the right for 1/3 of the revenue and record the following. Debit revenue $200, we fulfilled 1/3 of our obligation and reduced the liability. Credit revenue $200, we earned revenue now. If the apples cost us $100, we would recognize the cost at delivery in cost of goods sold as usual. Let's have a look at a software subscription example where we recognize revenue over time as service period passes by. Unlike apples, there is no physical delivery as such, but there is a constant usage of a service and access to it. So, a customer pays $1,200 for a 12-month image processing subscription. You earn it straight line across the service period as you grant access to the services 24/7 and you don't really care if the customer uses it or not. Your job is to grant access and secure the fully functioning service available to a customer. When you receive the prepayment, you would record debit cash 1,200, credit deferred revenue 1,200. Then, you recognize revenue as the service period progresses. Each month, you recognize 1/12 as revenue, which you earned by providing a service. Debit deferred revenue 100, credit revenue 100. After 12 months, the liability is 0 and total revenue is $1,200. You finally fulfilled your obligation for which you have received cash in advance. In this example, we looked at the monthly recognition. But as you provide the service 24/7, you can also do it daily or weekly, based on the complexity and resources you have. Of course, daily revenue recognition requires more efforts than the calculations on a monthly basis. Let's now have a look at gift cards and vouchers, another source of deferred revenue balances. Gift cards and vouchers are typically recorded in deferred revenue until used. Only when a card is redeemed, you recognize revenue and reduce the liability. If some cards are not expected to be used, under common policies you can recognize this revenue in proportion to redemptions, or when you're reasonably sure it will not be redeemed. This is called breakage. So, when you sell a $200 gift card for your Apple Jam, you record debit cash 200, credit deferred revenue 200. When the card is redeemed, you recognize revenue, debit deferred revenue 200, credit revenue 200. When the gift card is redeemed, that would mean you give your Apple Jam in exchange for it, and normally you would make some profit on it. Let's imagine the cost of the jam is $120. Then, together with revenue, we will record the following: debit cost of goods sold 120, credit inventory 120. And with that, we will get a profit of $80, which will end up in our equity. Now, time for a complication. When selling the gift card, based on our year-long experience, we know that approximately 10% of all gift cards are never used. Using this estimate, we can recognize the breakage revenue when we sell a gift card. 10% on the 200 card sale would be $20, and we reduce our deferred revenue by this amount, as we expect not to have this obligation on average. Debit deferred revenue 20, credit revenue 20. So, your deferred revenue, your liability will be $180. Loyalty points is another interesting case. Here, we defer part of the selling price. When you grant loyalty points with a sale, you allocate part of the selling price to a separate performance obligation. That portion becomes deferred revenue until points are redeemed or expire. When we sell apples for $200 and have a loyalty program with 5% in points, we record the following: debit cash 200, credit revenue 190, credit deferred revenue loyalty 10. We take out 5% of our sale for future, treating them as a prepayment. Kind of a customer bought apples for $190 and prepaid 10 for future consumption. When these points are redeemed, we record debit deferred revenue loyalty 10, credit revenue 10. Yes, we will now have revenue from the loyalty points and associated costs. Let's say 1 kilogram of apples costing $5 for $10 worth of loyalty points. When talking about deferred revenue, we should be careful not to mix it with refund liabilities. Deferred revenue is a promise to deliver later. A refund liability is a promise to return cash if a customer exercises a right to return. Many companies present both: deferred revenue for undelivered obligations and the refund liability for expected refunds. What is the role of deferred revenue in cash flow? In the indirect cash flow, increases in deferred revenue are an increase in operating cash flow. You collected cash before earning it. At the same time, decreases in deferred revenue are not an actual use of cash, but just reversing the initial add-back. The actual cash was received earlier. Think of it the following way: you recognize revenue, but the cash is not coming. You have collected it weeks or months ago. So, to offset that revenue and show zero cash flow from it, you reverse it by decreasing the liability from deferred revenue. And here are 3 quick checks for deferred revenue. Addition versus recognition. Are you growing the book of prepaid obligation? Are those additions profitable? Current versus non-current split. How much will be earned within 12 months and how much is a long-term commitment? Normally, the market doesn't really like long-term commitments. Customer churn hints. In subscriptions, large cancellations may slow additions and growth rates. Let's have a look at common pitfalls and what we can do to avoid them. The first one, recording revenue when cash arrives. Fix that by recognizing revenue when delivered or over time. Forgetting to amortize the liability monthly for subscriptions. Set an automatic schedule. Mixing refund liabilities with deferred revenue. Keep separate accounts. Ignoring breakage policy for gift cards. Document and apply consistently. Putting all contract liabilities into current liabilities. Split by timing. Here are a few quick controls that keep it clean. Keep a contract liability register with start date, end date, amount and recognition pattern. Link to invoices and contracts. Auto-post monthly recognitions. Review breakage and loyalty estimates regularly. Reconcile the roll forward to the general ledger every month. Let's summarize the lesson. Deferred revenue means money in before value delivered. Book a liability now, then recognize revenue as you deliver. Use clean entries for prepayments, subscriptions, gift cards and loyalty points. Watch the cash flow add back. Keep a clear roll forward. Opening, additions, recognition, closing. That is deferred revenue in plain language. In the next lesson we will cover payables, provisions, other liabilities and deferred revenue in real-life annual reports. If you have other questions to deferred revenue, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.